So hi everybody, my name is Bill Drexler, and if I haven't met you yet, I am a certified financial planner with Financial Cornerstone Group. Today's video is a little bit more of a conceptual one on the difference between market bubbles, market crashes, how they're related, and how you can mitigate the effects of those. So let's get started. So let's start with what a market bubble is. Typically, a bubble is an increase in an asset's price that is generally way above what that asset or company's fundamentals can support. Typically, it's way past the asset's true value or its intrinsic value. A good example of this would be the dot-com bubble in the early 2000s, where many tech and internet companies saw a surge in their prices, often sometimes speculative in nature, that were not backed up by that issuing company's fundamentals. This precedes the bubble bursting, causing the asset's price to revert back to the mean or its true intrinsic value, and really where the asset should have been priced all along. Another great example of this is the U.S. subprime mortgage in 2007 to 2010, which is what most people think of when they hear the term bubble. So this behavior is obviously not regulated towards modern times. Human behavior is human behavior. A good example of this is the tulip bubble during the Dutch Golden Age, where contract prices for some tulips, and they were recently introduced and fashionable, reach extraordinarily high levels, and folks were even mortgaging their home to purchase these tulips. And so the price acceleration began in 1634, collapsed in 1637, and it's generally considered to be the first recorded speculative bubble or asset bubble in human history. So a crash, on the other hand, is often quick and unexpected and unforeseen by most decline in an asset's prices. A good example is the stock market crash of 1929, which was one of the causes of the Great Depression. Other causes are often including unexpected catastrophes, wars, economic crises, and bubbles. They're often made worse and exacerbated by panic selling by the general public. So a prime example people often think of when they hear the word crash is the stock market crash of 1929. One of the causes was indeed a bubble in which enthusiastic investors, driven by the roaring 20s, borrowed funds, used margin to buy stocks, and thus inflating their prices way past the mean and their fundamental value. Other causes were lower wages, folks taking out large bank loans, and a struggling agricultural sector added to that and exacerbated the problem. And when the prices fell, panic selling occurred, and folks made runs on the banks to get out their money, thus exacerbating the problem to that. So unfortunately, these events are going to occur. We're going to see those in our lifetime, in our investing cycle. And it's always important to remember that for our younger investors, remember, it is not time in the market, it is time in the market. Being honest and removing certain biases that you may have when you're evaluating an asset or an investment. Look at its true or intrinsic value. Trusting a certified financial planner or investment manager to help you with that, to show you ratios, and to do some analysis of those positions. Remaining diversified, not just in different companies, but in different asset classes, different investment styles, and different tax status. And often it does include turning off the news, turning off the TV, logging off of Facebook, and talking to a fiduciary who's only interested in your specific situation. For our folks near or in retirement, it's a little bit different. We have to be honest with ourselves about how much risk we actually need to take to achieve our goals, and then be honest about how much risk we can take. And that's just a simple process of sitting down with a trusted advisor, with a fiduciary certified financial planner, to talk about what are we trying to accomplish, what do we want to do, and how much risk is it going to take to get there. Tax planning is huge. Tax planning with assets in different tax buckets, looking at different asset locations. Perhaps if you're conservative, keeping a year or two of living expenses saved in a relatively safer bucket. That way when the markets go down, you're not taking things out of a down account, but you have more readily available funds while those higher risk buckets can come back. Another thing is taking a look at our income stability ratio. So how much of our retirement income comes from stable sources, and those stable sources include a pension, Social Security, guaranteed annuities, things like that. And finally, it's keeping a big picture frame of mind, meeting with the certified financial planner who specializes in retirement distribution. So I can't stress that enough. You wouldn't go to a heart surgeon for a knee problem or vice versa. So look for a fiduciary, a certified financial planner who specializes in retirement distribution to help you with that. They will look at your unique situation and help you with that. I hope that this helped. Like, subscribe, and remember to be good to yourself and others, and we'll see you in the next video.